Hey everyone. So I want to do a quick reaction to a recent episode of the Money Guy podcast. I'm a big fan of the Money Guy show and what they do. They've really got a lot of great ideas. It's a great place to go to learn. I just thought that there was some discussion there that actually would be interesting to dive into and have a little bit of conversation around. Because I think maybe there's some additional considerations here, particularly on the topic of should you pay your mortgage off early? Now, quick setup here. Obviously, there's no one best way to ever manage your wealth entirely. I am a big fan of Dave Ramsey's baby steps. I think for a lot of people in the right situation, can be a good fit. It's certainly not the only option out there, and it's definitely not the only thing to consider, but this is going to be very related to what they're talking about here. Quick introduction. If you're not familiar, the baby steps, baby step 1, you'd save up a starter emergency fund of $1,000. Baby step 2, you would get rid of all debt except for a mortgage. So credit cards, student loans, anything else is there, you're getting rid of that. Baby step 3 is to fund a fully funded emergency fund. So here we're talking 3 to 6 months worth of expenses. Baby step 4 is to save 15% for retirement. Baby step 5 is to fund children's education. Then baby step 6 is to pay your mortgage off early. Now, if you're really aggressive in moving through those baby steps, I do know people who have gotten to baby step 6 and actually started off paying their mortgage and even fully paid off their mortgage in their 20s. So definitely people can get there. But it's a series of steps before you'd be talking about paying off your mortgage. So let's have a listen, and then we'll come back to some of my thoughts here.
It's Brian Preston, the Money Guy.
Because Alex asked a great question. He said Alex was listening to Dave Ramsey. He said Dave Ramsey recently did a video on paying off mortgage early, and he mentioned risk as being a factor people don't take into account. Is it really risky to keep a mortgage for 30 years? And I've heard this before. I've heard Dave say this a number of times, that like when people talk about like the paying off the mortgage early versus not, they always fail to bring risk into the equation. How would you respond to that? Or what would you say, or what would your response be as it relates to risk? And specifically ask the question, is it risky to keep a mortgage for 30 years?
I'm always surprised when I see this question because I see it all over media and it seems like everybody thinks this is a contentious thing. I don't think it is, because I think you have to look at, this is why we put age on there. 45, pre-45, after 45. That's the dividing line. I think that your risk, because let's talk about risk. Risk for all those people paying down a 2.5% to 3% mortgage under the age of 45 is, your risk is when you get to 60 or 65 when you need the money for retirement, you're not going to have it because you used all that army of dollar bills, the explosive 88 times over, all the compounding growth you could get with those dollars is being wasted on a 2.5% to 3% mortgage. That's the risk, that you are wasting the opportunity of investing those dollars at a young age when you have the most dynamic impact of compounding growth. Over 45, your risk is, because remember, there's two parts of the equation when you're building wealth. There's getting wealthy and then there's staying wealthy. Post 45, risk now pivots. You don't have as much compounding growth opportunity. And you're also trying to figure out, how do you take just risks that face you on a day-to-day basis off the playing field for you? That's paying off debt. That's getting out of debt, because you're not worried about the compounding growth as much. Now you're worried about keeping your wealth by making sure you're paying off all your debt so that when you retire, you're truly debt-free. There's no obligations on you. That's why I'm so shocked.
So first, obviously there's truth here in terms of the amount of time that you have for compounding growth. And it's absolutely true that if you're comparing, say, a typical stock market investment, historically speaking, over the long run versus paying off a mortgage, you're not actually going to get the same return. You're going to earn more typically in the market. But I think there's a little bit of nuance here that's worth diving into, because I think this kind of sets up the wrong comparison. Now, there's a relevant concept here to keep in mind, which is what's known as the streetlight effect. And the streetlight effect says that people have a tendency, and applies to all of us, often to look for evidence where it's easy to look, right? So the story here is that, maybe there's a drunk man out on the street late at night. He can't find his keys. He's trying to find them, and he's looking, beneath the streetlight. And somebody walks by and they ask, why are you looking there? And he's looking there because that's where the light is, right? Because that's where you can see. So he's searching where the searching is easy instead of searching where might actually be the most realistic or most accurate for getting an answer. And I think too often this mortgage discussion gets collapsed into the same type of thing, where we look at the mortgage comparison to the investments. And again, if you're going to compare those directly, this is a situation where we should account for the different risks. With a mortgage payment, prepaying that, you're basically getting a guaranteed return. You know what the return is going to be by prepaying that versus investing in the market where you do have to take risk. But again, setting that aside, the real issue here is that reality doesn't tend to play out the same for people who go on these different paths. If you decide to pay off your mortgage early, your life decisions down the road could look very, very different. I think this is particularly true for entrepreneurs, for anybody who wants to be a business owner. Really, when you free up your cash flow, you give yourself freedom where you're not going to be stuck in a job that you don't like. You're not going to tolerate a boss that is pestering you in a way that you don't appreciate. You're going to be better positioned to take advantage of opportunities that might come up. And that's the real freedom that's often missed in these conversations, because we're not looking at, somebody who gets rid of that mortgage payment, who totally knocks the mortgage off, now has so much less monthly cash flow to worry about. And again, if you're a business owner, you're somebody who that in particular is appealing to you, that sort of freedom, we're looking at a very different type of situation here. We're not really looking at a scenario where you're necessarily going to make the same choices. So you might be able to take an entrepreneurial opportunity where maybe it's a step back financially initially, one that maybe somebody with a mortgage payment couldn't afford to take, but has higher long-term potential. So more potential for growth. I think that's, again, just one potential example here where oversimplifying this, looking where the searching is easy, right? Where we're trying to say, okay, we can compare the rate of return you earn on an investment versus what you get from paying down the mortgage, might miss the broader picture and what could actually happen with somebody's broader financial situation.
That everybody thinks this is it's a binary decision of 0 versus 1. And no, there's the variable of how old you are, what are your goals. And it's crazy for 20 somethings to be trying to pay off that low interest debt when they're not funding 25% towards their future and investing that money. That's a much easier.
So real quick here, he just said, if you're, it's crazy to be paying that off if you're not already saving. And I think, again, that's important. Obviously, the baby steps, Dave Ramsey's baby steps are only going to say to save to 15% versus the financial order of operations, which is going to push you to 25%. But still, one thing I really like about the baby steps is you don't start paying down that mortgage until you're saving at least that 15% for retirement. So in this case, he's talking about kind of trading this false binary, but that's in a way what we're doing if we compare it that way. So somebody still could be saving their 15% for retirement and paying down their mortgage and doing those two simultaneously. Or even if they went to 25% and then want to save above and beyond that to knock out the mortgage, that might be something that works well.
Decision for me.
Yeah, we just had a comment come in, Brian, and it was, hey, if you pay off your mortgage at 45, that'll give you 20 years of supercharged savings. While that's true, the problem is that supercharged savings at age 46, 47, you already said this, isn't as powerful as your dollars are at 26, 27. You just don't have as much runway. We know that for a 20-year-old, $1 can turn into 88. By the time you're 40, that $1 can turn into 7. So you want those supercharged dollars to be put into the equation when it can be supercharged. Here's another really...
Again, fair point. But here, we're assuming your income and everything else about your life is going to be the same going down these two paths. And oftentimes I think that's actually not the case.
Common fallacy I see about prepaying mortgages early. All right, Brian, pop quiz. If you owe $500,000 on your house and you cannot make your mortgage payment, can they come foreclose on your house?
Yeah, of course.
Yes. If you only owe $5,000 on your mortgage and you cannot make your mortgage payment, can they come foreclose on your house?
Yeah.
Yes, right. So if the thing that you're worried about is not factoring in risk.
So, okay, yes, there's truth here. Obviously, they could foreclose on the house either way. I think, again, this kind of glosses over the reality, though, of if you owe $5,000 on your home and you're in a foreclosure situation, that foreclosure is not going to happen. You're going to be able to find some secondary source of funds, and that's going to be a different situation than owing $500,000 on your home. The other thing that doesn't get mentioned here, and I find that it's often less understood, is the concept of recasting a mortgage. So the idea with recasting is if you make an extra payment, your payment doesn't change with a mortgage, right? You pay ahead and your payment's still going to stay at whatever your 30-year, 15-year payment rate was. What recasting a mortgage does, you might have to pay $100 or $200 to have a mortgage recasted, and not all mortgages will allow it, but if your mortgage does, basically you can ask for your mortgage payment to be recasted to capture what payment would apply now that you've paid down or paid ahead on the mortgage. So that can actually reduce your payment. So if you are somebody who's paid $150,000, $200,000 ahead on a mortgage, it might be worthwhile to go through that recasting process, particularly if something's come up, expenses have hit you, there's some need, and that could actually reduce the required payment and actually get you in a position where you do have a lower monthly payment. So you can benefit from this. A colleague of mine, Michael Kitsis, who blogs at Nerd's Eye View, has actually written before about a neat concept that we don't see in the market, but I think would be really interesting, which would be an auto recasting loan. So basically a mortgage where if you pay early, each time you pay early, you're automatically going to get recasted and see that payment drop over time. Again, that's not something we actually see in the market, but that would be something that I think would be really neat. But the main point here is you actually can reduce your risk by recasting your loan, getting that payment down. And again, we're really talking about this cash flow risk, and in particular, the ability to kind of seize opportunities as they come up. So not assuming that your income's going to be the same at age 45. If you prepaid earlier, it might be on a different trajectory now.
The only time you remove that is when the debt is completely gone. Well, so from age 25 till age 45, where you're trying to rapidly pay off that mortgage, if you still have an outstanding balance, you haven't actually removed that risk until you get to past 45, until you actually get to the house being paid off. It still exists. It's not like you're saving yourself a lot if you have a $100,000 mortgage versus a $200,000 mortgage. The same risk that other people talk about is still there and present. I agree with you, Brian. I think for young people, the real risk is that you're not letting your army of dollar bills do what your army of dollar bills can do, at least.
So again, disagree slightly here because one, you could have that payment recasted, so you could actually reduce your payment. And two, you are getting rid of some of that. Now, a fair point here would be, especially when you're in those higher dollar amounts, so say $150,000 versus $200,000 remaining on a mortgage, you're probably not going to have a lot of options like you would in the earlier example, the $5,000 versus $500,000 to alternative financing if it were needed. But again, you are reducing the risk, and I feel like that's kind of being swept aside here in a way that diminishes some of the actual risk reduction that's occurring.
In like the 2.5%, 3.5% interest environment that we've been living in.
The straw man argument is that people, they turn it into the binary decision that you're either prepaying your mortgage or you're spending the money.
That's right.
And that's not what we're saying. We're saying that you're financial mutants. There's a third option is that you're not prepaying your mortgage because you're investing that money. I mean, because we could say it's always better to save than to spend.
Again, I just find this kind of funny because, yes, he's right. Absolutely. You could create that kind of false binary that he's talking about. You can do the same thing by setting this up to say that, again, somebody's going to be on the same trajectory no matter whether they have a mortgage, don't have a mortgage. And again, I think that's part of what's missing. And there's also just the psychological side of a lot of people really like getting rid of that mortgage. I find a lot of people are far more excited to pay down a mortgage and get rid of that debt than they are to save more into the retirement account. And particularly once we already have that baseline retirement savings going in. So again, I'm not a fan of somebody saying, I'm in my 20s, I want to knock out this mortgage before I save for retirement. I would not recommend that. But as long as somebody's got that baseline retirement savings working for them, they're likely going to be more motivated to save, let's say, an extra 15% of their income to pay down their mortgage than they would be to save an extra 15% just to put it into retirement. It just doesn't deliver that same sort of psychological benefit for a lot of people. And of course, it may not be everybody. Not everybody necessarily responds that way. But for those who do like the idea of getting rid of that debt, it's just a really powerful way to go. So again, just wanted to do a quick reaction. Big fan of what they do over there at the Money Guy Show. Really, really enjoy the content they put out a lot of great stuff. Not meant to be an attack, just meant to, have some discussion here, because I do think there's a little bit more nuance when it comes to this trade-off. And maybe it's not as easy as people in their 20s or 30s shouldn't be paying off their mortgage early. So what do you think? Leave some comments below, ask a question. I'd be happy to answer for you in a future video. Thanks, everyone.